Hello, Business 330. This is Professor Hassey. It's Saturday, October 3rd. This is our week number 5 of our Business 330 class. Another hybrid week. Our topic, investment return and cash flow. And my video this week will be reviewing problem in chapter 8 on page 263, questions 1 through 8, and problem in chapter 9, pages 296, 97, problem number 14. We'll be reviewing that. I'll be posting the spreadsheet in the Blackboard. You have an assignment due this Sunday, assignment number 2, which is on chapters 5, 6, and 7. That is due Sunday evening, tomorrow. Then I have posted already assignment number 3, which is doing similar work that we're reviewing today, chapters 8 and 9, and that is due next Sunday at 11 o'clock as well. So we have a class on next Saturday on the 10th before that assignment is due, if you have any questions considering that. Also, during the course of the week, on Wednesday, I'll be posting our week 6 introduction video. And also I will talk about the case paper topic, which will be distributed on Wednesday to Blackboard. So a lot going on. So let's take a look at chapter 8 problems on page 268, number 1 through 8. And we began that last week, and I provided you a spreadsheet to do that work on. So let's review that spreadsheet. If you remember, in chapter 8 and 9 is about investment return, investing in an asset, and is it going to provide us with the appropriate amount of return necessary to pay all the debt or equity cost associated with that, the cost of capital, and make an adequate profit. Well, we have 2 projects, Project A and Project B, in this problem in chapter 8. One, Project A, is for lasting 4 years at $80 net project cash flow per year. That's revenue minus expenses. And Project B is $200 expense or investment, the purchase of the asset, and generating $100 a year. The cost of capital is 11%, and we're asked to determine the net present value, internal rate of return, profitability index, and payback in years on these 2 projects. Well, first of all, to determine the net present value, you have to determine what is called the discounted cash flow. That's taking the flow of income or cash flow received in the future and discounting it back to today's dollars at 11%. So I'm going to go to my formulas, function, financial, and I'm going to look for the net present value. There it is right there, that function NPV. Bring that up. I type in the cost of capital or the cost of money in this problem. It's 11%. And then the value is I'm going to put the cash flow over the amount of years going forward that we're going to plan on generating from this $200 investment. So I just highlight year 1 through year 4. See there, B5 to B8. And then I just hit OK. And my total discounted cash flow is $248.20. That's the $320 of cash flow I'm getting into the future, discounted back at 11%. So my net present value would be the difference. My net present value would be the discounted cash flow less the amount of investment in year 1. And so if we take equals this plus this, we get $48.20. That's the net present value. So let's do it for Project B. Again, formula, function, financial, net present value. This net present value is nice because you can lob all years into one calculation. Again, the rate is 11%. And then the values here are $100 over 3 years. There he is right there, C5 to C7. I hit that, 244.37. So the net present value is the difference between the two, $44.37. So looking at the net present value in dollars, Project A is returning us a little bit higher return in dollars than Project B. My God, I'm yawning here. Wake up. The internal rate of return. The internal rate of return is the return in percent off this investment. And I'm going to zero out these answers here to show you how I got them. There we go. So the internal rate of return, again, there's another function for this one. It takes the investment in year 0 and compares it to the return over the life of the product, and it determines that as a return in percentage. So to do that, we go to Formulas, Function, Financial, and we look for internal rate of return, IRR. There it is right there, IRR. And all we do is put in the values, and we include year 0 through year 4, all the years of operation, including the year 0 when you're making the investment. So it's B4 to B8. I hit the OK, and there's the return in a percentage, 21.86. In other words, we're returning 21.86% of our money on this investment as profit. Let's do the same for Project B. Financial, internal rate of return, turn in the values, year 0, in this case to year 3, C4 to C7, hit OK, and 23.38. Now notice something interesting here. Oh, it might be interesting. Notice Project A is returning a greater amount of net present value dollars, but Project B is returning a higher percent return. Why do you think that is? I can't hear you. Well, probably it's impossible for me to hear you. But the reason for that is you're getting the money back sooner. You're only getting $300 compared to $320, but you're getting it back in 3 years, not 4 years. That getting back a little bit quicker is going to make your return higher. That's why a lot of companies want to get their money back as soon as possible. It gives them a higher return in percent. Even though Project B is giving you more money, profit, Project B is giving you it in a higher return rate because you're getting it in 3 years, not 4. Interesting. Okay, the profitability index is the relationship of the net present value to the investment. The net present value to the investment. Okay, so I want to take, it's a ratio, remember, so I just take 4820 divided by negative the investment, because they wanted that to be positive to get a decent looking ratio, and we got 0.24. Do the same thing here for Project B, 0.22. So the profitability index is the relationship of the net present value to the investment. It's a little higher. Naturally, the closer you get to 1, that's pretty cool. So that's that. And the payback in years is how long does it take to get us back the $200? All right. Well, that's easy to do for Project B. We get our $200 back in 1-2 years. So the payback in years is 2. Project A is $80, $160, $240. Well, we only need to get back 200, so it's going to be 240 in year 3. So $1, $2, and $40. That's 2.5 years payback. So we get our money back quicker in Project B, thus the higher percentage return. We get our payback a little bit later in Project A, but we're making more money as indicated by the net present value and the profitability index. The quicker you get your money back is a little bit better than overall making more money, but some projects don't allow that. You have to wait a little while to get, because of the project's length. And remember, the project's length is determined by its depreciation schedule, how long you can depreciate that asset, which makes up cash flow. So that's the answers to Chapter 8's problem, which gives us all the examples. You're going to need to know all these 4 methods, especially in Assignment 3. What is our net present value, internal rate of return, profitability, and payback. So this is a good template for that. Okay, the Chapter 9 tab in this is to determine not only the net present value, internal rate of return, profitability index, and payback, it's also to determine the cash flow. All right. In Chapter 8, the cash flow was given to us. Made it a lot easier. Now in Chapter 9, we have to determine how do we come up with that cash flow. And we're looking at page 296 and 297. A project that has 4 years, generating $40,000 of revenue every year. So let's put that in, 40,000 in year 1, 30,000 in year 2, 20,000 in year 3, and 10,000 in year 4. Notice how that my spreadsheet automatically started doing the arithmetic. All right. The investment in year 1 is $45,000. That's the investment. All right. They tell us in the project and the problem that working capital required in each year is expected to be 20% of revenues in the following year. All right. And the product requires the capital required to be expected to be 20% of revenues in the following year. And they also tell us, going out to the top of page 297, that the expenses of this project are 40% of revenues. All right. So our expenses are equals revenues times minus 0.4. Right? And we'll just slide that across and copy it. And there's our expenses. Okay. They also tell us the depreciation schedule. All right. At the top of page 297, it's straight line depreciation over 4 years to a salvage value of 0. So $45,000 the investment. So we just put in there equals 45 minus 45,000 divided by 4 years. And there's our depreciation schedule. Slide that over. Straight line over 4 years. We're depreciating the full 45,000. So look what happened. We take our revenues minus our expenses and depreciation. We get our earnings before tax. Our tax rate is given in the problem at 40%. And there's our net income. Notice in the 4th year, we're losing money when our revenues are lower. All right. They also tell us that the working capital is an investment of 20% of revenues in the following year. So 20% of 40,000 is 8,000. All right. Now revenues drop down. All right. So in year 2, 20% of 30,000 is $6,000. All right. So now we're going, our working capital should be 6,000. So we have to add back 2,000 in year 1. In other words, now our net working capital is $6,000, which is 20% of 30. 20% of 40 is $4,000. We got to subtract another 2,000 there. 20% of 10,000, excuse me, is $2,000. So we got to bring this down now to 8, 6, 4, and 2. So now our net working capital is $2,000, which is 2%, 20% of $10,000. And then in the 4th year, there's no more revenue. So we add back in another 2,000, because what happens, the rule, if you read in the chapter, is to have the working capital net to 0 over the life of the asset, over the life of the project. So we're spending 8,000 in working capital, and then as our revenue drops, we're giving some of that back in cash flow, and the net is 0. So we get our net cash flow this way. 53,000 we're off. This 45 plus 8. And then we have our net income plus back our working capital. But don't forget, we have to add back in depreciation because that's a non-cash expense. So we add that back in. And now we've calculated our total net cash flow earned off this project, which totals $62,000 on an investment of $53,000. Revenues, expenses, depreciation, tax, net income, working capital as a percent of income. Notice it all zeroes out at the end. And then adding back in depreciation, which is a non-tax expense. So we've just determined the cash flow. And now what we have to do is just like we did in the chapter 8 problem, now that we've determined the net project cash flows, and we'll go over this again next Saturday, but it's pretty straightforward. The only real difficulty is this working capital line, but if you study it in your text, it makes sense. So first of all, what is our discounted cash flow? Now they tell us in the problem on the top of page 297 that our cost of capital is 12%. 12%. So now I'm going to take this cash flow and discount it back at 12%. Formula, function, financial, NPV. There it is there. Our cost of capital in this problem is 12%. And now we go to value. And now we just paint from year 1 to year 4, $48,622.29. Uh-oh, a loser. And we take the difference between what you're spending in year 0 and what our discounted cash flow is. We're losing $4,377.71. What's our internal rate of return? Same procedure. Function, financial, internal rate of return. And now we don't have to type in a percentage. We just go from year 0 to year 4. 7.5%. Notice our cost of capital is 12 and we're earning only 7.5%. That explains why we're losing money. Profitability index, this is going to be a negative, equals present value. Let's make sure I put in my equal sign, equals present value, net present value, divided by the 53,000, and we get a negative 0.08. Not good. And the payback in years, well, how long does it take us to pay back the 53,000? All right. At the end of year 1, we have 20,900. All right. So that means at the end of year 1, we've invested 53,000 and we've paid back 20,009. We still got 32,000 left. In year 2, we have 32,100 left, and we've paid back 17.3 in year 2. We got 14.8 back. In year 3, we have 14.8 left to cover in our cash flow, and in year 3, we earned 13.7, a little bit left. So when we do that same formula, we have 1,100 left, and we add in the project cash flow here, 10.1, we're over. 1, 2, 3 years, and then all we do is take what percentage 1,100 is equals minus 1,100, because I'm converting that to a positive, divided by the amount of cash flow in year 4, and that in a percent, or let's make it a decimal, which is a percent, is 0.11. So 123.11 years to pay back. In other words, it takes us 3 years and then 0.11% of the 4th year to recoup the $53,000. In other words, this doesn't look like a very good project. All right. But the key thing here is for you to understand and practice getting the cash flow, because that's huge. And we're going to be looking at that next weekend and in your assignment number 3. So that's problem 9-14. Determining not only the 4 return investment criteria, dollars, percent, ratio, years, but coming up with the net project cash flow, that is huge because you have to do this in order to get these numbers. And that's the key to getting capital budgeting problems and investment return problems, is these formulas or factors are pretty straightforward. The big hassle is making sure you correctly come up with the net cash flow. It's an income statement plus or minus working capital and adding back in depreciation. And there's no salvage value in this problem. If we had salvage value and getting money back at the disposal of the asset at the end of its life, we would add another line here for salvage, but there's none in this problem. So that's problem 9-14. I urge you to look at that this week because you're going to be tested on that, assessed on it in assignment number 3 on the definition of that. And we're going to be talking about this again next Saturday as well. So chapter 8 is how to calculate these 4 calculations, which tells us what type of return we're getting off an investment. And chapter 9 is we're calculating how to determine the cash flow to determine the investment return. 2 important numbers in finance: determining the return on investment and determining the cash flow into the future that's being generated off the investment. Okay, so if we go to our Blackboard site, here it is right here, and we go to the assignments and final examination file folder, click on that, you'll now see assignment 2 is there from last week. You've been working on that this week. Some of you have already posted it. That's due tomorrow evening, Sunday at 11 o'clock. And then I've posted assignment number 3. And this is due next Sunday, October 11th at 11 o'clock. Notice the weight of the assignment increases. Assignments 1 and 2 were 10%. Assignments 3 and 4 will be 15%. Note that. Also note assignment 3 is to be done in a spreadsheet. Either Excel, Mac numbers or Apple numbers, or Google Sheets. Spreadsheet file for assignment 3, which means part of assignment 3 is multiple choice. You'll just put those multiple choice answers in the spreadsheet file. And then I'm going to ask you to do some calculations and some analysis for assignment 3. So that's your work for next week. But again, we can go over any questions you have on this, either in our office hours during the course of the week or in next Saturday's class. And if you go to week 5, our no class this week, open up that file folder, you'll see the spreadsheet that we just worked on for those review problems right here, and a little bit investment return definitions, some information about the reading material, which we went over last week, and some more definitions and PowerPoints of the chapters and a couple of videos. Our financial fact this week is capital budgeting. Pretty important to read that. It defines everything that we're going to be doing. And then next, this coming Wednesday, I'll post the work for week 6 and the subject of our class next Saturday, October 10th. So there's our Blackboard site. So you're concentrating on week 5 this week, our review problems that we just went over, and some information about the topic. And then we'll talk about this in the class next week, but also class next week, chapters 10, 11, 12, and 13, but you're only reading sections of those chapters, and I will post those to week 6 file folder later on this weekend, and I'll introduce those in our introduction video on Wednesday. So that's our lecture and quick lecture for this Saturday, and I think that'll give you a good start into looking at problems in chapters 8 and 9. And remember, you have an assignment due tomorrow night, and then one next Sunday as well, and they're posted in Blackboard. So thank you, everybody. Enjoy your weekend, and we'll see you on the internet again on midweek and getting ready for our class next Saturday morning. Any questions, be sure to let me know, and I'll talk to you all later. Bye-bye.